All right, so let's be honest here. There is a problem with Bell. BCE saw its stock price from 2022 around 70 bucks going all the way down to almost $50 right now as the market is doing okay, but Bell is definitely not going towards the right direction. So today we're going to do a deep dive into Bell and see what the problem is and how it can be solved going forward. Dividend growth investors, bonjour, my name is Mike Yehu and I'm the founder of Dividend Stocks Rock. I'm also a passionate investor and I have this YouTube channel to help you invest with more conviction so you can enjoy your retirement. And I received a lot of questions about Bell, probably because you are an income-seeking investor. You're seeing this juicy yield above 7% now and you're thinking, what's going on, right? So let's get started with the dividend triangle right here. So the dividend triangle for Bell, as you can see, the revenues are pretty stable. They're growing a little bit every year, which what you can expect from a mature business. Let's keep in mind that Bell is playing around with two other big players, so TELUS and Rogers. Together, they control about like 85-90% of all the wireless products. They obviously have wireline services with cable and internet, and they also have a small media business. I say small because it's only like 13-15% of their business, but still pretty huge when you're looking at the networks that they have in Canada. So revenue going up, that's all right, but earnings per share, damn. It's going up and down, not really under the right trends right now in 2023. So maybe it's the weight of debt, maybe it's something else. We're going to have to take a deeper look here to understand what's going on. And for the dividend, what is kind of like shocking for a business that is supposed to be mature, that is not growing that fast, and definitely has some problem because the market is like dumping the shares like there's no tomorrow, and yet they keep increasing their dividend by 5% every single year. So that doesn't make any sense, right? So let's take a look at the dividend growth profile. This dividend growth profile is provided for 1,100 stocks at Dividend Stocks Rock. You can see that we have like the yield, the frequency, the average 5 yield, which is kind of interesting here because right now we have a yield of like 7.5 while the average 5-year is 5.70. So it tells you there's either a deal or there is a problem. And the problem is probably what I've circled, I've put in red right there, is the payout ratio. I mean, 127% payout ratio. The cash payout ratio is not any better at 171%. So how in the world, the 1 year, 3 years, and the 5 years are incredibly like clockwork 5% increase. 14 years of consecutive dividend increase, and yet I see a big problem there. So what I did is, as I like to do, is when I look at the numbers and it doesn't fit with the narrative, I look at the financial statements. So for this video, what I decided to do is to take all my answers from the annual statement of 2022. Obviously, then you need to check what's going on in the quarterly earnings, but we're not gonna look at the quarterly earnings of 2023 just because it's the same story basically. So I rather look at a full year to have more information, and then we're gonna go from there to do our analysis. So let's get started with one of the first page of the 2022 annual income report that tells us the payout ratio should be between 65 and 75. Let's take a pause here and think about that. So 65 to 75% of free cash flow. So I thought at first, okay, so maybe they have some kind of tricky way to calculate the free cash flow, because obviously free cash flow is something that we all know how to calculate it. But then I thought, well, we're pretty far away from that, so there must be some trick. But on the following page, they actually admit that right now the payout ratio is above 100%, and actually it has been for the past 5 years. So while they have a policy for the dividend payment, they're not respecting it for the past 5 years, and they're already telling us 23 it's not going to happen either. We're still going to be over 100% payout ratio, and this is what we have seen so far over the past 3 quarters. So again, should we worry because the dividend payout ratio doesn't match the dividend growth policy at all? So I would say that most of the time, this is a huge red flag and this needs more investigation. So what I started to do is I looked at the dividend paid over the past 5 years, the free cash flow, and the cash flow from operation. What you see on this graph is obviously as years goes by, they increase their dividend, so the amount of dividend to be paid is more and more. On top of that, BCE is not known to buy back their shares. Maybe management should consider that right now since the stock price is so low, but that is another story. For the free cash flow, we see that it hovers between 2.5 and 3 billions. Definitely not enough to cover the 3.5 billion paid in dividends. So again, we can see still the same problems coming over and over again, but then cash flow from operation are very strong. I mean, 7.6, obviously it's on the downside for 23. So that is a bit of a concern, but overall, the main problem here is we're missing something in this graph, because there is enough cash from operation to cover the dividend, but when you look at the free cash flow, that cash has disappeared. So going back into the financial statements, and yes, when you have those questions, you need to dig deeper, you need to look at the numbers, and you need to do your due diligence. And this is what I'm trying to show you today, how to do it, between a website that provides you a lot of financial information upfront, like DSR, and then complementing with the annual statement or the quarterly earnings from the company's website. So what we see here from the statement of cash flow is the capital expenditure. So we're talking about roughly 5 billion per year. 5 billion. That's a lot of money. But that's the thing. They had to develop 5G technologies over the past 5 years. They had also to expand their network. But what is interesting is as you read in 2022 annual statement is they're telling you, well, right now we have like 82% of our coverage area that offers the 5G. We're about to finish the expansion of our fiber network to provide fiber internet. So right now what I hear and what I read is CapEx should be slowing down going forward. We're not there yet, and this is what has been disappointing in the recent earnings for Bell is we're still having some kind of like a pretty strong CapEx. The cash flow from operation are still struggling, but that will be the name of the game. If they're not able to A, decrease the CapEx, and B, increase the cash flow, what happened is they're getting into more debt every single year because they have to finance. And now you're gonna say, yeah, they're financing their dividend. No, they're financing their project. That's how business works. They have a huge project, they look at their cash flow and they say, hey, we're missing $1 billion. So we're going to see our banker get $1 billion and invest in our projects. Of course, they could decide to stop paying a dividend and finance everything by themselves. But as shareholders, we would not like that, right? But keep in mind, management will focus on the good well-being of the company and their projects and their growth first, and they will never think about your retirement. That's not of their concern. I'm not saying that Bell's going to cut their dividend. I don't think they will. But here's the story: the next earnings, what you need to look at, like in the quarterly earnings and the story that needs to develop. Those numbers needs to work at one point. So now I know that there's a cash flow problem. I know that there will be a debt problem. So those are two things I need to investigate even further. But right before I did that, I thought, well, am I looking at a business that is dying right now? Because this is not the story I want to, and I don't want to invest in a stock that is definitely dying. So I took a step back and I look at the business model to see if the business is actually growing or dying slowly. So I already saw that in the revenue, it's going higher, not that much, but slightly. And in the annual statement, you can see that the bulk of their business is either wireless or wireline services. You have like roughly 13-14% coming from media, but the bulk of it, it's really the wireless and the wireline. Overall, BCE revenue grew up by 3% last year, so it's not incredible, but this is what I would expect from a mature business. So between 3 to 6%, it would be unreasonable to expect Bell or Thales or Rogers to grow their revenue year after year, like high single digit to double digit. I mean, they are operating in an oligopoly. They can grab some market shares, but then they're like fighting against like companies with about the same size, about the same resources. So the best organic play here is to get more new customers as immigration and the population grows in Canada, and that's pretty much how they're gonna be able to make money. One other thing that I've looked at is, are they gaining clients or not? So just wanted to verify if they were actually able to get more people on board, and they are. So you can see that for both wireless and wireline business, they're getting more customers. So at least we have a small growth story, which you should expect from a mature business. So that thesis works out. So they're operating in an oligopoly, their market is somewhat secure. Of course, the government would like to have more competition, but it's nice to want that. It's another thing to make it happen. So far so good. Bell is on a growth path that is like modest growth, but still enough to pay a dividend and continue to grow, right? And to survive. So I'm not worried about the future of the company. So the next step is I need to look at the debt status, right? So finance cost 21 to 22 increased by 6%, 60 something million. So not much here. And most of it actually didn't come because of higher interest rate expense on the existing debt, but because they contracted a little bit more debt. So here they're telling us we do not feel the weight of higher interest rate in our balance sheet. I'm like, really? You don't feel that? How is this possible? So again, another step of an investigation is to look at their debt maturities. So at first they're really good to tell us, oh, we have our debt maturities for the next 13 years. It's all spread out. So okay, so is it like coming up in the next 2 years, the bulk of it, or it's going to be in the future? So I went flipping the pages. I know it's like I have 100+ pages to look at, but you need to find those answers. Fortunately, I'm doing this video for you guys so you don't have to do it. At least a good part of it's a good shortcut. If you like the video so far, give me a thumbs up, subscribe to the channel, please, and send that to one of your friends. I'm sure you know someone that has some shares of BCE, so he will thank you to watch this video. Contractual obligation. What we see here is the debt maturity. What I find very interesting and a bit comforting about it is in 23 we have less than $1 billion to renew. In 24, 2 billions, and then you see 2 billions, 1.6, 1.7, and then after 2027 you have the bulk of the debt that is up for renewal. So of course they're going to renew debt that is like around like 2-3%, and it's going to probably be like 5 or 6% interest rate. It's going to increase their debt payment, but as they tell us they're going to slow down their capex, they should increase their cash flow from operations, so the free cash flow should increase gradually. They should be in a position that they don't necessarily need to increase their debt level. Actually, what I would like to see in the next quarters, and this is what is really important, is yes, I want to see an improvement in the cash flow, but I want to see what they're doing with that. I would like to see at least first the debt being stabilized and then being paid off. So if in 24 they are able to pay off $1 billion in debts or 500 million, that's going to be a pretty good sign, and it's going to help them as well to lower or maintain their interest charges, because it's going to increase very fast if they don't do anything. The second thing I would like to see is management like having this cash flow situation resolved and start buying back shares, because at $50 I think it's a great deal if the business is able to prove us that their narrative makes sense. So this last chart summarizes what you need to look at in the coming quarters. Better cash flow from operation, stronger free cash flow, and obviously lower capex. At one point, it's fun to spend money, but the more you spend, the more you get into debt, and the more investors are getting concerned. So now it's time to show some results, and I'm hoping that Bell is going to be able to do that in 2024. So here are a few key points to look at. Cash flow from operation, free cash flow, capital expenditure, debt level, and the pace of the dividend growth. As long as it's around 5%, it's great. If it's lower than 5, here's your red flag. Keep in mind, I recorded this video right before BCE announced their latest reports. So if they announce their dividend growth for 2024, I still don't know it at the time of recording. So don't go in the comments and say, yeah, it's 2%. Why you have not telling us? But those are the key points you need to look at going forward. I hope that you have enjoyed this video. Don't forget to give me a thumbs up, subscribe to the channel, and make sure that you come back on Thursday in the meantime for the next video. And in the meantime, don't forget to stay invested.